Well, good morning, everybody. My name is Frances Castnetta-Dice, and I'm president of the Houston Easton Chamber of Commerce, and it's an honor to welcome you to our COVID-19 business webinar sponsored by Weaver and Tidwell. Today is June 19th, and we're very honored to have two experts from Weaver and Tidwell to talk about the PPP loan forgiveness, which is it's one of those times where we never understood where we never were prepared for a COVID-19 to come to our country. But now that it's here, the government has given us PPP loans. A lot of our businesses have applied, have received them, and now it's time to make sure that they do get that forgiveness that was dictated and know what borrowers should know. So you're in for a real treat today. We have two wonderful speakers, Sean Muller, CPA, and also the Chief Operating Officer for Tax Services at Weaver and Tidwell. We also have Sonia Desai, who's also a CPA and Director of Forensics and Litigation Services at Weaver and Tidwell. So I don't want to take up much more time for the introductions. We're going to go ahead and get into the program. And Sean and Sonia, thank you so much for joining us today. I know you, Sonia, live in Austin, and Sean, you have ties to UT Austin. So I love this connection here. And I did not go to UT Austin, but that was one of my first choices. So I love this connection that we're having right now. But right now, we're going to turn it over to Sean to take control over the screen and present what borrowers should know. Thank you both for joining us.
Well, thank you, Frances, for this warm introduction. Good morning, everyone. We're going to spend the next 50 minutes probably talking about PPP. We maybe go over that. We are going to be monitoring your Q&A, so if you have some questions, feel free to ask those, and we will try to answer those along the way. The rules have changed a lot. So let me try to get control of the deal here. There you go. So, one thing I want to kick off with this is the rules are constantly changing. We were actually making changes this morning because the Treasury released a statement last night to modify some of the rules from the Senate bill that was signed by the President on Friday afternoon. So those changes continue to happen, but we're going to give you the most up-to-date knowledge we have. Unfortunately, for the last 2 months, Sonia and myself and our team spend countless hours constantly checking the U.S. Treasury website and the SBA website to see where we stand with everything, and they are always changing. So a little bit about Weaver before we get started here. Weaver is a top 35 firm in the country, primarily in Texas. Houston is our headquarters, but we have offices throughout Texas and then also LA, Oklahoma City, and New York. We're a full-service firm. You can see all the different services we provide. Did not know over the last couple of months that we'd become a PPP consulting practice, but we've added that now to our business services. So key guidance to date, these are all the different things that are out there. As you can see, there have been tons of new rules that have come out. The forgiveness application was originally released on May 15th. So it was released 6 weeks after the initial legislation of the CARES Act, which was March 27th. And then we had June 5th, the PPP Flexibility Act was signed. And then Treasury responded to that last night to say they're going to modify their application. So more to come on this for sure, but it is an everyday deal. You look at the interim final rules, they were releasing something about every 2 to 3 days. This is what we're going to cover today. We're going to cover key terms. Then we're going to go into the reductions and the safe harbors. That's really what people are missing in all of this, and they have not corrected that in the rules. Then we're going to talk about some of the application issues and then documentation, and then leave some time for questions at the end if we don't get through the questions during the presentation. So just the brief overview of the plan, and we were talking to Frances about how to do this. Wanted to give an update of kind of where we are. $659 billion was authorized for the plan, and many of you know the first tranche was $349 million that was gone within about 8 days. As of today, we still have $149 billion remaining to disperse, and that's why you're getting a lot of press and why there's congressional hearings about what's going on with the program, why isn't money being spent. I did want to point out for those of you that may not have applied for the loan that are thinking about it, you have a June 30 deadline to be approved as of today's rulings. So if you are planning to apply, you really need to get on it and apply here in the next week or so the bank can approve your loan and disperse the funds. So some of the issues we're seeing with the program and why the funding is really slowed down is the rules are constantly changing. When this was first released on March 27th, it was looked to be as a grant, and basically whatever you took out would be forgiven, and there were no requirements or no strings attached to that. So let me go back here. All right, I'll wing this part of it. So there were strings attached to it. Now they've attached strings. Now they've changed the application. Now they've changed the rules again. And then a lot of the lenders didn't want to do it. They didn't think the fee was worth it, and they also didn't like the some of the requirements that were put in there by the SBA that the SBA would guarantee it. Well, lots of these banks don't want to have a 1% loan on their books for any amount of time, and now they're being told that loan can sit on their books for 5 years. So we're going to go into really the changes from the Flexibility Act to what was originally put in and what's been revised. They've extended the covered period from 8 weeks to 24 weeks. So that is welcome for some people, but as we're going to talk about, this extension could also cause some issues for you in doing your calculations. They've modified the 75% forgiveness amount has to be used on payroll. They've now amended that to 60%. In the Senate Act, it was 60% of the total loan, so that was really going to bite a lot of people if you didn't spend all your money. But now they've amended that instead. You just have to spend 60% of the forgiveness amount on payroll. So that's been a welcome change. The program was scheduled in June 30th. Now they're ending it December 31st. And as I just mentioned, they've extended the loan term from 2 years to 5 years. And now they've extended the deferral of principal interest from 6 months to up to a year. And then there's another caveat about 10 months. Here's another troubling part we'll get to on exemption. There were some rules in the application and then some of the CARES Act about some exemptions for voluntary terminations or employee requests to leave or terminations for cause. The Senate bill was very limited on the calculation. It said you have to make a reasonable attempt to rehire, and you have to be able to show that you tried to fill the position and you were unable to. So it actually made it harder in our minds in the revised bill than what was on the application. What didn't change in the Senate Act? So the PPP funds still need to be spent on the same 4 categories: payroll-related benefits, mortgage interest, rent, and utilities. So that hasn't changed at all. I know there were lots of folks that were asking to be able to spend the money on whatever they wanted to, or actually spend it on protective equipment, masks, sanitizer, whatever it may be, and they did not change that. The other piece is, which was a big thing, the expenses, if your PPP funds are forgiven, the expenses related to those funds are not deductible. Treasury came out and released a notice that said the expenses would not be deductible. Congress immediately came out and said, that's not right, that's not our intent, we're going to change that. They had a chance to change it in the House and Senate, neither one of them did it, and the president signed a bill without that expenses being deductible. So unless they change something again, do not plan on deducting those expenses if you're planning on forgiveness. With that, I'm going to turn it over to Sonia to talk about some of the key terms.
All right, so the covered period begins on the day that the lender first disperses their loan funds to the borrower. As Sean kind of alluded to, originally there was an 8-week covered period term. The recent Flexibility Act has extended that to 24 weeks. While the program has been extended through the end of the year and several of the deadlines involved in the forgiveness piece have been extended to the end of the year, which we'll get into, as Sean said, really the application piece to get a loan has not been extended. That will terminate at the end of June. Existing borrowers as of June 4th, when the Flexibility Act was passed, only they can elect between the 8-week period or the 24-week period. So any new loans that are issued since that date will have to go with the 24-week covered period.
So Sonia, in the 8 weeks versus the 24 weeks, if you elect the 8-week deal, are you able to use the old rules, or you have to use the new rules for the 8 weeks?
You still have to use all the other new rules. The only thing that you can keep from the old rules is the 8 weeks.
Okay. And there was a question that was brought in about the June 30th deadline for loans. You have to get your loan approved by June 30th. So if you wait too long, the bank may say we're closed for business. So don't submit your application on June 30th and expect to get your money. You have to have your loan approved by June 30th. Oh, okay. This slide didn't come out very well. Let's see.
No.
See if I can get it back. Oh, it did not translate over. All right.
That's okay. So the alternative payroll covered period. So the forgiveness application actually introduces this concept of an alternative covered period for payroll costs. And so what that is that you can effectively choose the beginning of your covered period for payroll costs only to begin on the first date of your first pay period following the date of disbursement of your loan funds. So, and this, of course, this only applies to certain borrowers. So if you have a biweekly or more frequent pay frequency, then you can elect to use the alternative payroll covered period. But if you use semi-monthly or any payroll frequency less frequent than that, you don't have this election. You have to continue to use the standard covered period. The other thing, as I mentioned, this is only for payroll, so all the other non-payroll costs will still have to track and follow your standard covered period, which begins on the date of loan disbursement. So the forgiveness application modified this term of incurred and paid. You know, the statute, the original statute had this requirement that to be eligible, costs had to be both incurred and paid during the covered period. The forgiveness application modifies it to say that any amounts paid during the covered period or the alternative period, or incurred during the covered period and then paid on the next regular billing date following the end of your covered period, that either of those are includable for forgiveness. So, you know, what that means is that it seems to allow you to include expenses that you may have accrued prior to your covered period, but that you paid during your covered period, that those would be eligible expenses for forgiveness.
So, Sonia, you want to clarify on this that the big reason for the alternative payroll period was the fact that, you know, people are getting funded on a date. Maybe I can give an example about it, but they were getting funded on a date and they were wondering if it included all the payroll prior, et cetera, et cetera.
Yeah, it really is for administrative ease. It helps borrowers align their covered period with their pay periods, which of course makes a lot of sense. And it avoids the whole issues with bifurcated pay periods at the beginning and at the end of your covered period. So here's an example. If we have a PPP loan that funded on April 27th, the borrower pays weekly payroll, so that means that they would be eligible to elect the alternative payroll covered period if they choose. Their next payroll begins on May 4th. So your covered period options for payroll costs are either April 27th or May 4th. And then for the non-payroll, you would have to use the April 27th as the beginning of the covered period. So the forgiveness application also clarifies some other terms related to this incurred or paid. With regard to payroll specifically, they clarify that what paid payroll means is any paycheck, basically if the paycheck is distributed to the employee, that's considered paid, or if the borrower originates an ACH credit transaction, that would qualify as paid. As far as the incurred piece goes, payroll costs are considered incurred on the day that the employee's pay is earned. So effectively, when the employee works, it's considered earned. For employees, cash compensation is limited to that $100,000 annualized amount. And so that would have to be prorated over your covered period. So depending on if you're using the 8 weeks or the 24 weeks, that would mean a cap of $15,385 over an 8-week covered period, or $46,154 over a 24-week covered period. There's a slightly different rule for owner employees or self-employed individuals, general partners, which is that your maximum cash compensation during the covered period is limited to the lesser of that 100,000 annualized number or the prorated amount for your 2019 compensation. So for owner employees that didn't take a paycheck, for example, you would not be able to claim any payroll during your covered period.
And so, Sonia, does this compensation limitation apply to benefits as well?
It does not. This is just for cash compensation. Benefits are not part of this cap. I will say, though, that for depending on the type of entity, an owner employee may not be eligible to claim benefits. So, for example, a general partner will not be able to include benefits that they received.
Thanks.
Yep, so that's a good segue. So cash compensation includes gross salary, gross wages, gross tips, and commissions. The interim final rule released on May 22nd on forgiveness finally clarifies that bonuses and hazard pay actually are eligible payroll costs, so you can include those. Those, of course, you're still going to be limited to that 100,000 annualized cap. Any paid leave, so vacation, family leave, medical or sick leave that is paid, but not including any amounts paid under the FFCRA, those are includable as payroll costs. And then, of course, any amounts paid for dismissal or separation would be included as well. Other payroll costs, so these are the non-cash compensation category, would be any contributions that the borrower makes to a group healthcare plan. Our understanding is that would include, medical, dental, vision, short-term and long-term disability as well. Any payments, contributions made by the borrower, the employer to an employee retirement plan also included in payroll costs. And then any state and local taxes on employees' wages. So federal taxes, of course, are not included. They've never been included, and that has not changed.
So a popular question we always get it on the retirement plans, and can we pay that during the covered period and get a deduction? And we believe you can. But if your normal payment of the plan shows up outside the covered period, then you're going to need to do some adjustments with your benefit provider.
So a quick recap on the incurred or paid for non-payroll costs. What this includes, as we know, is any interest on a covered mortgage obligation. This is both on real or personal property. Any covered rent obligations, again, on real or personal property. And then covered utility payments for a service or for the distribution of electricity, gas, water, transportation, telephone, internet access. What we understand now for the transportation, what that means is, the SBA has clarified that would include gas, for example, for employee-owned or leased vehicles. And as far as what a covered mortgage or covered lease would include is any agreement or service that was in effect, a written agreement that was in effect prior to February 15th, 2020. So prepayments, there's been a lot of question about whether or not prepayments of these eligible costs are allowable and includable for forgiveness purposes. The forgiveness application appears to specifically prohibit any prepayment of mortgage interest, but it is silent on prepayment of payroll, rent, or utilities. The original legislation and the Flexibility Act, neither of them really say anything about prepayments at all, only that you cannot prepay the principal amount of a mortgage obligation. So it appears that prepayments for payroll, rent, and utilities are included. However, there's definitely been a lot of commentary, including from bankers, that have warned against this, suggesting that it goes against the intent and spirit of the program. So we are still definitely waiting on further clarification from the SBA on this issue.
We have been advising clients, especially if they're using the 8-week covered period, to go ahead if they've got leftover funds or they want to go and do this, to go ahead and prepay during the covered period because of the definition of paid or incurred and paid. And so you can't prepay, after the covered period by the end of a cycle. So if you're going to attempt to prepay this and include it, you need to prepay during the covered period. You can't wait until after, before the next pay period, anything like that. So go ahead and prepay during your covered period to meet the paid definition. And then you can worry about it on the application if they're going to forgive it or not. But we believe it's better to go ahead and pay the amounts and then be able to defend it on the application.
So there's been a lot of questions about how the SBA wants us to calculate a full-time equivalent employee. They finally clarified in the application and the related interim final rules that they want us to use a 40-hour work week. So for every employee, you would take their average number of hours paid per week during the covered period. So add up their total hours during the covered period, divided by the number of weeks in your covered period, whether that's 8 or 24, divide that by 40, and then you would you would round that to the nearest tenth. The maximum that you can claim for any employee is 1, so the FTE is capped at 1. They do provide for a simplified method to calculate FTE. Again, kind of for administrative ease. What this allows you to do is take a 1 full-time equivalent for any employee that works at least 40 hours, and then a half of an FTE for any other employee that works less than 40 hours. It's important to note that for the simplified method, you're comparing, as long as you're using the same methodology to calculate your FTE, a lot of the reduction calculations are asking you to compare one period with another. And so as long as you're using the same method in both periods, there shouldn't be an adverse impact of using one versus another. And I would even say that if you are a borrower that has a lot of part-time employees, and if you happen to have reduced the hours for those part-time employees, you should go ahead and use the simplified method, because they're going to be at 0.5, both before and after the reduction in hours. Another thing to note real quick is we've seen from clients, a whole range of calculations for a full-time equivalent employee. Many people using monthly averages, pay period averages. The application is pretty clear that it wants you to use a weekly average. Now, this might change in the new application, but at least what we know now is they want you to do a weekly calculation.
So it's a pretty onerous calculation if you have any number of employees at all, because it's not what you're used to doing. So there's a lot to the application and all the backup.
So here's a quick example. Let's just use one employee. Here's the various different weeks in your covered period and the hours that they worked. They worked a total of 280 hours. So we divide that by our 8-week covered period. Divide that by 40 to get 0.875, and then you round that to the nearest tenth to get a 0.9 full-time equivalent for that employee. So what if an employee doesn't work during the entire covered period? As we'll get into a little bit later in the presentation, the SBA does provide some exceptions to the full-time equivalent reduction in certain specific situations. Outside of those allowed or permitted exceptions, you would effectively have to include the employee in your average calculation at 0 hours. If there were certain weeks that they didn't work, they would be a 0 for that particular week. And then, if an employee requests a reduction in those hours, as we'll get into a little bit later, that's one of the permitted exceptions as well.
All right, so
back to you, Sean.
Yeah, I'm going to talk about reductions and safe harbors, and then we're getting some questions about that. So this is really the complicating factor in all of this. Is most of our clients or non-clients are asking us different questions. They think if they spend all the money on the qualifying expenditures, they're home free. It's really not the case, because there's two different reductions that are either based on total headcount or based on reductions in pay we're talking about here. So the first reduction, which is applied first, is if you've reduced your employees' compensation, either their hourly wage or their compensation by more than 25%. This applies to all employees that make less than $100,000 during 2019 on an annualized basis. We'll have an example of that to show where it's not as simple as just pulling a W-2 for your employee and using that number. The other piece is if you reduced your FTEs. Obviously, during this epidemic or pandemic, there's been some terminations, and so the whole purpose of this loan is to rehire people or keep people employed. So they've put some penalty provisions in there if you do not bring everyone back. And there are some safe harbors, which we'll get to, which we've always called the get out of jail free card. So the first reduction is we just gone through. If you reduce an employee's compensation or their hourly wage by more than 25%, you're subject to a limitation. Also, this is added to 2019, but on the application, which hopefully they fix in the revised application, you now have to pick up any employees that were hired in 2020. So you could have an employee that makes over $100,000 that you've hired as of January 1, 2020, that is subject to this calculation. So think about if you bring in a highly paid sales manager that's going to make $150,000 a year, but due to this, you've cut their salary. You could have a reduction in your forgiveness amount because you reduced that salary. So here's an example that we go through. This takes one as a salary employee and another takes an hourly employee. The salary employee is easier to look at. Their first quarter was the measurement date. So their first quarter, their salary annualized was $80,000. Their threshold is $60,000. That's 75% of the 80, and you're paying them $50 during this covered period or the alternative covered period. So because of that, the difference between 60 and 50 is $10,000. That's on an annualized basis. So you need to adjust that for the covered period, and that's the multiplier effect you see. And so the reduction for this employee is $1,538. So if you look at your total eligible forgiveness, you have to subtract these reductions out before you apply any headcount. So as you can see, it gets to be, this is on one employee. You've got to do this for each and every employee you have, whether they were hourly or salary. The next example is on your hourly employees. This person was working 50 hours a week. They were getting paid $32 an hour. They've since reduced that down to $20 an hour. So the threshold is 24. So there's been a $4 reduction in their hourly wage. The way the application reads, you have to multiply it by their hours during the measurement period. So in this case, there'd be a reduction of $1,600. So if you have two employees at the end of your covered period, you would have a $3,100 reduction in your eligible amount for forgiveness. There are some complications in here, which we'll go through in a minute for headcount. You need to consider where you are in your headcount as well. So they're trying not to get you to double up. That was one fear that we had, is that you could pay, let's just say you don't hire an employee back, plus you reduce salary or you reduce hours. Your headcount could be reduced as well, and then your comp is reduced. So they didn't want you to get a double reduction for the same employee. So they'd have to modify this application, but that probably goes well beyond the scope of this presentation to go through that example. So this is the measurement period you have to look at if you want to get a full exemption. So what they're saying here, this goes into get out of jail free a little bit, that you, if you reduce their compensation between February 15th and April 26th, which was a month after the CARES Act was passed, and then you restore their average annual salary or hourly wages by December 31st, 2020, that's an amendment of the Flexibility Act. You've got to restore these amounts back to the February 15th pay period. If you do that, then you don't have to worry about this safe harbor at all. So you're excluded from that. So here is the reduction in the full-time equivalent employee. Sonia already went through how you calculate what an FTE is. So you have to take your eligible forgiveness amount, which is, we don't have a full example of this, but it's your payroll, rent, utilities, and mortgage interest in the 60-40 split. So you calculate that amount first, then you reduce it for the reduction. So if you look at our example before, we had a $3,100 reduction. You'd reduce that, and then now you multiply it by the FTE headcount reduction, which now takes your average full-time equivalents during the covered period divided by full-time equivalents during a measurement period, and that comes up with a ratio. If you look here, your measurement period can be any number of things depending on if you're a seasonal employer or a regular employer. It can either be a prior year, February 15th to June 30th of 19, or it can be the current year. Obviously, you want to use the smallest amount possible, lowest number possible for your measurement period because it's a ratio of covered period over measurement period to reduce your reduction. And once again, what Sonia talked about, this is a weekly calculation you have to do. So if you pay every 2 weeks or once a month, doesn't matter, you got to look at this weekly. So here's an example that we went through. Borrower has $50,000 PPP loan. We're just talking about payroll to make it simple. They have 8 FTEs and they paid $40,000 during the covered period. And then they had a reduction because they didn't pay their employees the same rate they were before. And then they originally had 10 employees during the measurement period. So if you look at this, the example is the borrower spent $40,000. They're expecting a full forgiveness of the $40,000. Because of the salary wage reduction, they have a $10,000 reduction, so they're at $30,000. Then they apply the reduction quotient, which is 8 FTEs during covered period over the 10 of the measurement period, so you reduce it by another 20%. So now you've spent $40,000 and you're only forgiven 24. So you owe the $26,000 plus you owe the employer portion of employment taxes and FICA taxes. So this is not what many employers or many borrowers thought they were going to get. They really were expecting to get a full reduction of $40,000, and in this case, they are not. This is just an example of why, one, the calculations are very complicated, and also why many borrowers are very frustrated with this program and not wanting to go through with it because this is not how it was advertised to them. So here is the reduction exceptions that Sonia mentioned and talked about in the Act. So on the application itself and in the CARES Act, there are these rehire exemptions. During the application, they came out with this provision that says, as long as you've made a good faith effort to rehire someone and they reject the offer on their own behalf, or you've terminated somebody for cause, or the employee is voluntarily resigned or asked for reduced hours, then you get to exclude that person from your headcount calculation. So that was a good thing, right? Because people were worried about this termination for cause. If I have a bad employee, what can I do? I don't want to keep them on the payroll just to keep them on the payroll. The other piece here about rejected, that's been a lot of stuff in the press, is that many employees that have a variable compensation were turning down their job offers because they wanted to remain on unemployment. It wasn't much of a difference to them. So these were good facts in the application. In the Senate bill, the Flexibility Act, they've added in another requirement that you actually have to show an inability to hire individuals during this period up through December 31st, 2020. So they've actually cut back on what the application allowed for, and the Flexibility Act did not even address if you terminate for cause or if the employee quits on their own or asks for reduced hours. They didn't even address that. However, given the way that this bill has gone through, we don't expect the Treasury to modify their original terms on the application. But it's not part of the Senate Act as of now, but something to watch. One more thing that they've added in the Flexibility Act, which was new, is this government out. And so if your business is unable to return to the same level of business as of February 15th, because of guidance issued by Health and Human Services, CDC, or OSHA, beginning on March 1st all the way through December 31st, 2020, then you're not required to even apply this headcount reduction anymore. So this looks like a great thing, and it reaches out. We immediately reach out to restaurants that are having to worry about a lot of their rules and how they can't come back to full capacity. But a borrower today is in the middle of their covered period, and so it'll be over prior to December 31st, 2020. So what are they to do in doing their calculations? Because you just don't know how it's going to end out. So this is the safe harbor we mentioned that allows you to restore, to allow to restore your FTE levels. The whole point was you needed to restore during your covered period or by June 30th was the original rules. But now with the change from June 30th to December 31st, it's become way more complicated. And now the concern is, do you have to keep the same headcount all the way through December 31st, 2020, even though the money may have run out? So that's just something we really can't tell you the answer. I don't know, Sonia, you want to add something on that? Or, it's what scares Sonia and I a lot.
Yeah, and excuse me, I was also going to ask Sean, so the way that the safe harbor works in the dates that are specified within the safe harbor for new applicants for a PPP loan, their covered period hasn't even started yet. So for those applicants, we're basically saying that these safe harbors aren't available, right?
Right.
Yeah.
All right, with that, I've got all of the slides. I touched a key and there you go. So I'm going to turn it back over to you to talk about some of the overriding issues we're seeing on this.
Okay, so the forgiveness application had this language, which is the borrower's eligibility for loan forgiveness will be evaluated in accordance with PPP regulations and guidance issued by the SBA through the date of this application. And the SBA may direct a lender to disapprove the borrower's loan forgiveness if the SBA determines that the borrower was ineligible for the loan. So I guess the question is, there was an FAQ 17 specifically that the SBA released several weeks ago that alluded to the fact that a borrower and a lender could reasonably rely on the laws, rules, and guidance that existed as of the date of the application in submitting their application. In other words, they wouldn't be held to new rules that came out after they applied that may make them ineligible, for example. So does the application, this language specifically, override the guidance that they provided in FAQ 17? I guess one of the reasons that this is important is, as Sean indicated earlier, that the rules are constantly changing. They're releasing, not only by legislation, but also through FAQ, interim final rules. And so as a borrower, you're going to need to keep up with the changing rules throughout your covered period, but not only the covered period, the program goes through the end of the year. So are you now going to have to stay on top of the rules as they keep changing and make sure that you are in compliance, in some cases, even after your covered period has ended? So we think the answer is yes, based on how the application is worded.
And right now, if you've even elected, you want to elect the 8-week covered period, the SBA won't even accept your forgiveness application right now. So you're just going to sit there and wait.
Yep. So pretty much along the same lines, the application does state that the borrower is going to have to comply with the rules as of the date that they apply for forgiveness. And as Sean just said, if they're not accepting applications yet, particularly for those that are electing to use a 24-week period, you've still got a ways to go until you reach the end of that. What new rules are going to come out that might or might not change your eligibility and various other calculations? And then also, when do you apply? Those electing the 8-week period, in theory, you could apply for forgiveness. You want to, I think, apply for forgiveness immediately and have the funds forgiven. But there's various safe harbors and calculations in here that require you to meet certain thresholds for headcount and wages and salaries as of December 31st. So are you now required to wait until the end of the year before you can even apply for forgiveness? We think that that's what that means. Yep, we can move on. So quick calculations here, examples to run through how the forgiveness amount is calculated. The application effectively selects between the lesser of three amounts in how much would be forgiven. The first amount is your loan amount. The second is dictated by the amount that you spend on payroll and is based on the payroll threshold. So in the original statute, that requirement was 75%. And then finally, there's the calculated forgiveness amount, which is the amount that results after you apply all of the various reductions and calculations. So in this example, if we have a PPP loan amount of $550,000 under the original statute, there was a 75% payroll requirement. So you would effectively be limited to a $400,000 forgiveness amount. And then the last amount, let's assume here, the calculated forgiveness amount was $450,000. So in this example, you would be limited to the lesser of, which is the $400,000. And that means that you would still owe the $150,000 plus any accrued interest. On this next example, we have updated the payroll requirement, which is now only 60%. So with the same numbers, you've got a loan amount of $550,000, but now your payroll is, if you spent $300,000, you're going to be limited to $500,000 for your forgiveness amount. And then your calculated forgiveness amount still $450,000. So in this case, you actually go with the lesser amount, which is $450,000. So you do get an improvement in your forgiveness. You now only owe $100,000 plus accrued interest. So the 60% definitely makes a big difference.
Yeah, and we put this example in here because as of yesterday, the loan amount was a cliff vest. So if you didn't spend 60% of your loan amount on payroll, you got no forgiveness. Treasury modified that last night to make that more borrower friendly. So that's a great thing they did.
So this is just a high-level overview of how the order of operations works on the calculated amount. You add up all of your eligible expenses, so your payroll, your mortgage interest, rent, lease, utility amounts, and then you first are going to apply your salary or hourly wage reduction amounts for each employee to get to kind of a subtotal of eligible costs, and then you apply your FTE reduction quotient to the total amount. So your FTE reduction quotient is not only reducing your forgivable payroll costs, but it reduces your total eligible costs. And then that calculated forgiveness amount is, of course, going to be one of those three amounts that the SBA will look at in determining your actual forgiveness.
Yeah, and so Sonia, go through and one of the calculations we're trying to do, and our clients are asking all the time is, do I reduce headcount and pay more? Do I reduce salary? How best to do this? And it really sort of depends. You got to run the math, but it really depends on your non-payroll costs and what you're spending and how it affects your forgiveness, right?
That's right. If you're spending mostly payroll costs and you don't have as many of the non-payroll costs, then the reduction quotient is less of an issue. It's not going to reduce, your rent and your utilities. But if those do end up being a big chunk, up to 40% of your total forgiveness amount, then that could be a pretty good haircut.
And you want to address how one thing on the payroll costs, I think many of our clients are thinking is they now have 24 weeks of payroll, so it exceeds their loan amount, and so the reductions don't matter anymore. You want to address that?
Yeah, that's a good point. So several of our clients have, after this new legislation that now gives them 24 weeks to pay eligible payroll costs, they think that they can put their total payroll costs for the full 24 weeks into this calculation. And when you do that, oftentimes you're going to spend way above your loan amount because, there isn't enough. What you really got was 2.5 months of payroll. And so you don't have 24 weeks of eligible loan amount to pay these payroll costs. They seem to think that if you did that, the haircut, the FTE reduction isn't going to matter. It's just going to bring them back down to their loan amount. Well, no, you can't put in costs, eligible costs, whether it's payroll, rent, utilities, or interest that exceed your loan amount. So if, for example, you use up your PPP proceeds in the middle of your covered period, continue to pay payroll and rent and interest and utilities, you cannot include all of those costs into your calculation for forgiveness.
Thank you.
So we've kind of touched on some of these already as we've talked about, the calculations on the other slides, but the extension of the covered period has been really good for certain borrowers, in particular, borrowers like restaurants that have been severely impacted by the shelter in place and they simply haven't been able to operate at normal levels. This is giving them a chance to spend the PPP money, giving them more time to spend the money. But the real question is, you now have 24 weeks in your covered period, so you have to run all of your FTE reduction calculations and your salary and hourly wage reduction calculations over this 24-week period. So are you going to be able to maintain your FTE count and your salary and hourly wages over this longer period of time? In the example I just gave, if you use up your PPP funds by week 12, you still have several weeks left in your covered period. And if you don't have the funds to retain all of your employees, you're going to have a major FTE reduction to struggle with over, the rest of your covered period. And that's going to impact your forgiveness amount. So the question is going to be, if you are in that position where you're choosing between the 8 weeks and the 24 weeks, how likely is it that you're going to be able to maintain your FTE headcount and your salaries and hourly wages throughout your covered period? Because even if you spend all of your money now, you still may have a costly haircut at the end of the day.
Sorry about that, Sonia. I was getting crazy with the up down and making you remember it. So
no problem. I kind of have this memorized anyway. So. So Sean talked about this new exemption that the Flexibility Act provides for restrictions put in place by the government. And so it's a really good out, if you will, for certain borrowers. But, just to draw your attention to certain limitations within this exemption, it only relates to reduction in business activity resulting from COVID-19. That also relates to the maintenance of standards for sanitation, social distancing, or other worker or customer safety issues. So if you've experienced a reduction in your business activity that results from COVID-19, but is unrelated to social distancing or these other requirements that are put in place by the government. So for example, just consumer sentiment. People don't want to go to the movie theater yet. They don't want to go eat in restaurants yet, even if they're starting to open back up. Well, can that be included? Are you going to be allowed to claim this exemption if the reduction in your business activity is, unrelated to the maintenance of certain standards and social distancing, but still related to COVID? A lot of businesses that are experiencing disruption in their supply chain, for example, may not be a result of social distancing requirements, but certainly is a result of COVID-19. It's unclear if you're going to be able to claim this particular exemption for that type of reduction in your business activity. So as you're filling out your application and completing your certification for this exemption, you're going to need to think about, well, how do I isolate the impact of COVID-19 that falls under this exemption, and then those that fall outside of the exemption? That's certainly going to be a complicated process. And then also, there hasn't been any guidance yet on how they define business activity. Is that just a reduction in your sales, or is it cash flows, profits? Another interesting thought is, you may be a business that is a supplier to restaurants. Restaurants certainly have been impacted by the social distancing and sanitation requirements. So can you claim that you, as a supplier to that industry, have also been impacted? So there's a lot of questions still on this, and hopefully the SBA will clarify. So this is kind of out of place in this slide deck, but I think important. It has a lot of things that we wanted to highlight as far as completing the application as it stands currently. On Schedule A to your forgiveness application, you're required to bucket your employees into Table 1 or Table 2. And so just to highlight the differences and kind of who goes into which bucket, if you have an employee with annualized compensation of less than or equal to $100,000 for all pay periods, so in other words, no single pay period in 2019 did an employee earn more than $100,000, that employee goes into Table 1. If you have an employee that did have annualized compensation of more than $100,000, that employee goes into Table 2. If you're an owner employee, you don't go into either Table 1 or Table 2. Your cash compensation is dealt with completely separately, and you will not be included in the FTE reduction calculation or the hourly wage or salary reduction calculation. And then, as Sean highlighted earlier, if you're a new employee in 2020, then you will go into Table 1. So, that was not in the original statute. That was something that came out in the application. We thought that new employees wouldn't be subjected to these various reductions, but it turns out that they will be. So just real quick, an example at the bottom there. If you pay semi-monthly and employee A was employed for all of 2019, had an annual salary of $85,000, but that employee received a $5,000 bonus in that very last pay period. For purposes of this calculation, you would if annualizing that last payroll, you would end up exceeding the 100,000 annualized compensation. So, you would effectively have an annualized cash compensation of over 200,000 in just that one payroll. So, in that situation, this employee would fall down into Table 2 and would not be subject to the salary and hourly wage reduction, which is the thing. And a lot of our clients actually oversee this kind of nuance of this calculation.
Yeah, you want as many people as you can get into Table 2 for this forgiveness calc.
Yeah.
So before we get into documentation, I see some questions coming in, so I'm going to try to answer those questions before we go into it. The first question is that is there a spreadsheet template we can have? Here's our promotion plug here. We have developed a reduction model or a forgiveness application. We're not giving that away for free, but we do have either consulting on that, and we're able to turn the application over to you for a price, or actually do the calculations for you and run through it. So if that's interest to you, you can please let us know. And there actually are some free sites out there as well. I think Mark Cuban worked with a group to try to come up with a free site, but then we actually went through and troubleshot through the model, and it actually wasn't working properly. So there's something to think about here. What kind of documentation is needed to show you are unable to rehire similar type positions to secure the exemption? I think for this is a job posting would be something, and then contract offers along the way to see what you can do. That's going to be a really tough thing to go through there. But do the best you can, just like any other job offer. Another question here is about actually a specific case about the FTE calculation. In this case, the employee went down to part-time, and then they hired another employee. So yes, you would actually have a higher FTE count than you did during the measurement period. Francis, do you want to add something at all about the calculation?
Myself, no. That's not my question, and I think it's just one of our chamber members asking specifically a case relevant to them.
Okay, got it. And here's been, let's see, it has been in the news that some companies have applied, but then when the rules changed, they decided it was not the best choice for the organization and decided to not move forward. If I decide afterwards I don't want to move forward with the loan, is it a hard process to reverse? It is not. It depends on the process you go through. If you get approved for your loan and then you go to them and say, I don't want the funds, that's easy. If you actually have received the funds and you decide to pay them back, you can just return 100% of the funds. There will be accrued interest on them.
Sean, are you there?
I think he's frozen.
Uh-oh.
Oh, there you are.
I'm back.
You're
okay.
back.
So this is a question. If there are no safe harbors for new applicants, what is the incentive to apply? I froze again.
No, we can hear you.
All right, I'm sorry, I froze again. I looked at your screen here. So I found that the bankers really are not reviewing all these requirements with folks. They're really leaning on us a lot for this. So I really talk to your advisor or reach out, or you can actually ask your bank, maybe they know. Is there a timeline with important dates? Well, we've put in a lot of the measurement periods in here for you to look at and different qualifications around here, but there's no deadline on the SBA or Treasury to respond. They respond when they want to respond, unfortunately. If an applicant receives forgiveness of some amount of their loan and there is a remaining balance, Are banks selling these loans as secondary markets for servicing? And then follow-up question, any thoughts on how banks will interpret these PPP loans with their customers? Yes, there is a secondary market for these loans, and some banks are selling these loans off. So you would have a new bank servicer. And then we are concerned that if the debt does stay on your books, it is a debt. And so it could impact your ability to draw down on revolvers or get other debt while this loan remains outstanding. Can you utilize the 24-week extended time only for expenses other than payroll? Should you submit more expenses than required just in case some are disallowed at some point? The first question is, it's all or nothing. So you can't elect 24 weeks for your non-payroll and 8 weeks for payroll. It's 8 weeks or 24 weeks for both. Should you submit more expenses? I think you should report all the expenses that are paid up into your loan amount for purposes of forgiveness and walk through with your lender on that. Is there any value in submitting applications earlier or later? Right now, you can't even submit a forgiveness application, so you're at the whim with that. If you've spent all your money, we're advising clients to submit their applications as soon as possible before rules change again. Sonia, you want to add anything on that, or are you good?
No, I would agree with definitely. If you're closer to having spent the money and you haven't had to take major haircuts yet, then sooner the better.
And this next question is a very complicated question that's more specific. If an employee refuses to come back, then effectively in my mind, they voluntarily approved to cut their hours back. And you don't necessarily have to pay them full time to get the full PPP loan. If they're refusing to come back for whatever reason, they've requested to have less hours. So with that, I want to go back to our documentation. We got 2 minutes for this, but I was hoping to get some of those questions. Real quickly on documentation before we run out of time. You have to submit everything required by the lender to get forgiveness. The main two things you have to submit are the forgiveness application, which we said will be revised, and you have to submit Schedule A of the forgiveness application. Those are two pretty easy forms. There's a lot that goes into Schedule A. So you're going to need to pull all that information together yourself to support everything on Schedule A, and then also to support everything that's non-payroll related. So here's a few things you're going to have to keep with you. Please note that you're going to have to maintain all of your documentation for 7 years. So it's a really long time for that piece. Here you've got to have lease obligations, mortgage obligations, payments for your utilities, etc. And then here's the big key. You're going to have an authorized representative of the borrower that actually agrees to all of these things and all their nomenclature. So there's about 6 things you're having to sign off on. And then also the SBA stuck in on their application. They can request anything they want on the application. And if you don't comply with their request, they can turn down your application. So here's a lot of stuff you've got to keep track of for FTE headcounts. You need to keep track of your employees during all of these periods in order to really calculate your eligible forgiveness. And then another piece they've added to the application is you need to know your employees at time of loan application, which probably is not included up above here on a specific date, and then actually employees at time of forgiveness. And they're also asking for, on the current application, employees as of June 30th, and so it'll be as of December 31st in the new application. Here are some certifications you have to make that prevents us. We're not going to be an agent in this case, so we are assisting clients with what the forgiveness application looks like, but we're not going to certify any of this. This needs to be the representative for the borrower. And with that, we are at the hour. So Francis, do you want to close us down here, and anything else?
Yes, I'm so sorry about that. But yes, absolutely. And thank you both. And I know that a lot of our members are appreciative, and it showed by the multiple questions that we're asking. This is very confusing. Some of the comments on my Facebook Live was, this is confusing. no one, not your presentation, but just the whole aspect of PPP loans and how to pay it back and not to be penalized, et cetera. So I'm thinking that, and all of us are hitting the reset button personally and professionally of making sure that we're in the right careers, that we're doing the right stuff. And it looks like a lot of business owners were not prepared paper-wise, accounting-wise. Are there any tips, Sean and Sonia, that you can give to business owners that are going through this, because this could happen again, another crisis could happen again? What do business owners need to do now in this reset period to be prepared for the next time?
Gosh, I hope we don't have another PPP program. But it's just keeping track of your employees and then making sound business decisions. I think one thing we've learned during this PPP process is that people started running their business as mandated by the government, as opposed to running their businesses in the best way they could. I really feel bad for many employers that borrowed this money thinking it was free money to them, and then they changed the way they did their business, and now they're waking up to say, why did I keep this employee, or why did I do this or that? Just continue to run your business the best way you can, and know that there's almost no free lunch in this world, is what I would say.
That's a good answer. Very good answer. Sonia, anything to add?
Yeah, just along the same lines, I wouldn't forget that ultimately this is a 1% loan. And so the worst case scenario is not terrible. If you didn't get 100% forgiven, you could continue to use this money to keep employees employed beyond your covered period for up to 5 years, and for new loans, and 2 years for existing loans. And so that's actually a pretty cheap payroll line for a lot of employers, so don't lose sight of that either.
Right.
And then also, Sean, you mentioned that the SBA, everything is changing on a daily basis. You were changing your presentation today. Is there a site that they can follow you guys on to find out what those updates are? LinkedIn, Facebook, your website?
Yeah, so we do have a resilient COVID-19 resilience and recovery page on our website at weaver.com. We're constantly posting blogs, and we actually have other webinars on PPP and other non-PPP things related to COVID-19 on our website. And then if you don't want any material that we have as well, there's actually voluminous information on SBA.gov and then the U.S. Treasury website. But we really try to monitor the SBA and U.S. Treasury and condense that information down and put content out for our website users.
Great. And again, this is going to be live or stored, this recording live on our website. So next to that, we'll put your website so that we can make sure that people know to go to that page to find out that information, because it is going to continue to change on a daily basis. And then lastly, I was impressed with your that reduction model spreadsheet that you have for purchase. Is that available on your website, or can we put a link on our website for people to download that and purchase it?
Yeah, so we're happy to send you the sort of the price list and what it is. Similar to something like that, it offers options. So we'll send that out so you can put that out for your members, and then that will be on our website. If it's not there now, it'll be in the next day or so. So we'll be happy to send that to you for your users to see.
Great, because again, this is all new to everybody, and if someone can crack the code like you've done it and make it a little bit more simplistic so that we're not spending extra hours trying to figure it out, this would be beneficial to us all.
Yes.
And then, in closing, I know that we're all trying to bring people back. We're trying to bring the country back, and that's part of the reason for the PPP loans. Do you have any other advice for these business owners, PPP loan or not, if they're struggling or if they're not? What any kind of words of encouragement for when things get back to normal, and maybe how they can either keep what they're doing or change what they're doing?
Ooh, that's a mouthful, right? We've been on this for a while. I think that we're a resilient country. We're certainly a resilient area in Houston, and we've always been business focused. So we will get through this, and we will move forward. People that run their business prudently will come back stronger than ever. Those that tend to think that I can borrow today and get it back in the future are going to have more problems. Obviously, using technology in your business to constantly evolve what you're using on your business side would be helpful. But I think we're going to come back. I mean, we're in a great spot. Most people want to be in Texas.
I agree. And Sonia, anything to close with?
No, I think that's a great note to end on.
Great. And again, we are becoming more, that's why we're doing these virtual webinars, so that maybe other companies will get on this bandwagon as well. Thank you both very much for joining us today. I know it's going to be beneficial to all. On our website, we have a list of all of the past webinars and future ones. We'll make sure that your website is on there, and we appreciate all the time and effort you're doing to keep us East End strong here. Thank you, guys.
Thank you.
All right. Bye-bye.
Bye-bye.